All right, today we're going to talk about two of the most notorious acronyms in all of finance, CMO and CDO. Now, these aren't just some boring Wall Street terms. No, these were the financial engines, the very heart of the 2008 global crisis. So how do we get there? How did a financial product, an innovation, bring the entire world's economy to its knees? It really all comes down to this one simple but huge question. How did something as normal as a mortgage on a house get all bundled up, sliced, and repackaged into what was basically a weapon of mass financial destruction? Well, to figure that out, we've got to go back to the beginning. So the whole story starts with a really basic problem for banks. See, when a bank gives you a 30-year mortgage, their money is tied up for 30 years. And they thought, man, we want that cash back sooner so we can lend it out again and, make more money. And this led to a totally game-changing idea from Wall Street called securitization. It's actually a pretty clever concept. You take a whole bunch of assets that you can't easily sell, like mortgages, you bundle them all together into one big pool, and then you slice up that pool into new investments that you can sell. So what happens? The bank gets its cash back right away to make new loans, and the investor gets a nice, steady income from everyone's mortgage payments. I mean, on the surface, it really did seem like a win-win. This whole idea really started taking off in the 1980s, and that brings us to the first main character in our story, the Collateralized Mortgage Obligation, or the CMO. So, what exactly is a CMO? Well, it's pretty much what it sounds like. It's an investment, a security that gets its value from a big pool of home mortgages, and only home mortgages. You can kind of think of it as the pure version of this whole idea. Now, the real genius of the CMO, and as we'll see, the real danger, was how they were structured. This big pool of mortgages was sliced into different pieces called tranches, and each tranche had its own level of risk. The way it worked was, the principal from the mortgage payments was paid back one tranche at a time, sequentially. So the safest, top-level tranche got paid back first, then the next one down, and so on, all the way to the riskiest slice at the bottom. It was a pretty neat system, based on the simple, predictable idea that people, for the most part, pay their mortgages. But Wall Street. Simple and predictable is never enough. The huge success of the CMO led to a bigger, bolder, and frankly a much, much more complicated sequel, the Collateralized Debt Obligation. And right here, this is the most important difference. A CDO isn't just backed by mortgages. No, a CDO could be backed by almost any kind of debt you can think of. We're talking car loans, credit card debt, student loans, corporate debt, you name it, they throw it in there. It was the same basic idea as the CMO, but just pumped up on steroids. So let's put them side by side because this really makes it clear. A CMO, mortgages only. That made it pretty simple, pretty transparent. You knew what you were getting. But a CDO? That thing was a Frankenstein's monster of different debts, which made it incredibly complex and honestly almost impossible to understand what was really inside. And while some CMOs had government backing, kind of like a safety net, CDOs were purely a private sector creation, no safety net at all. And it was this complexity, this ambition, that turned a cool financial innovation into a ticking time bomb. This is where the story really takes a dark turn. So how did it all go so spectacularly wrong? Well, it started with a deceptively simple and dangerous trick. Remember those super risky bottom-of-the-barrel mortgage tranches from the CMOs that nobody else wanted to touch? The CDO issuers had a brilliant idea. They just bought them all up, bundled them together with a bunch of other debt, and basically hid them inside these new, super complex CDOs. And the craziest part? The credit rating agencies looked at these things and stamped many of them with their highest possible rating, AAA. So investors thought they were rock-solid safe. The risk was totally hidden in plain sight. So fueled by a red-hot housing market and this new magic trick for hiding risk, the CDO market just absolutely exploded. I mean, in 2002, it was a tiny little corner of the financial world. By 2007, it had grown to a truly mind-boggling size, just in time for the housing bubble to finally pop. How mind-boggling! At its peak in 2007, the total value of the CDO market was $1.3 trillion. Let that sink in. A phenomenal amount of money, all resting on a foundation that was getting shakier by the day. And when the housing market finally did turn, the whole thing came crashing down. And it was fast. It was brutal.
These complex securities that the rating agencies had promised everyone were as safe as gold, stamped with that precious AAA rating. They became completely worthless. It felt like it happened overnight.
So, after the dust settled and the world was picking itself up from a global recession, what did we actually learn from the wreckage of this financial house of cards?
Well, for starters, the collapse was just devastating. From that peak of $1.3 trillion, the market basically vanished. By 2013, it was a tiny, tiny fraction of its former self. Think about that. Over $1 trillion in perceived value, just gone. And the fallout was huge. Investors lost billions. I mean, in just one single deal that the SEC brought against Goldman Sachs, investors lost over $1 billion. The regulators came in and fined issuers for not disclosing the real risks. And yeah, believe it or not, CDOs do still exist today, but they're supposedly under much, much tighter scrutiny now.
So, what's the big lesson here? What's the takeaway? It's this incredible paradox. The very same process, securitization, that injected so much energy and money into the market also created this incredibly complex, tangled web of risk that brought the entire system crashing down. The innovation was both the engine and ultimately the bomb.
And that really brings us to our final thought. These tools, these acronyms, the fundamental idea of slicing and dicing up debt, it's all still out there. Sure, we've added more rules and more oversight, but it leaves us with a really critical question to think about. Is the system today truly safer, or are we just waiting for history to find a new way to repeat itself?